When it comes to debt, I try to tell my clients that there is what I would call a debt continuum. And what I mean by that is that there are various lending institutions, and they change as you move down through this continuum. So I would argue that on one side of the continuum, what you have are what we call institutional banks. Now, the institutional banks are generally these national footprint banks, the U.S. banks, the Wells Fargos, those types of banks. Now, quite frankly, they are very prescriptive. They have actuaries who figured out an awful lot of things and data-driven to figure out what kinds of loans are going to be most likely to be successful for the institution and what loans are likely to go into default. And so what they do is they create a variety of different rules. A particular rule might be, say you need to get a loan, you might have to have a 700 or better credit score. So if you came in and your credit score was maybe 695, you might not get that loan. And even though that individual might be wearing a badge, that says he's a vice president, in all likelihood, he is not a person who can make those kinds of decisions and change things because they have a single program, and all he can do is put you into, or she can put you into that kind of program that it already exists. But inside of that, we have what we call community banks. Now, community banks are the smaller banks that are around town, and here where I live, some of those might be Pikes Peak National Bank or Stockman's Bank, those types of banks. These are smaller ones. Now, let me be clear. When you talk about the word bank, banks are FDIC insured. That's what makes them a bank, which basically is a government insurance policy that tells the bank that thou shalt not make risky loans because they have a depositor's insurance, which is that FDIC insurance. Now, so they are bound by certain rules. But when you move from an institutional bank to a community bank, the community bank may have some set products, but they can also somewhat tailor them. So the way I like to explain that to a lot of people is I had a client who had a landscaping business, and he attempted to go ahead and buy a new dump truck for his business. Now, the issue was he went to all of the institutional banks and they all turned him down, and they turned him down for one single reason. And they said that essentially that during the winter months, even though he had a snowplowing business and a lot of other things, but quite frankly, he did not generate the kinds of revenue during the winter months to be able to make the bank feel comfortable that he would be able to make principal and interest payments during that period of time. And so as a result of that, they all turned him down. Now, the community bank still has the same rules that they have to apply to, but they can change the way the program works a little bit. And so in this particular case, he went to one of the community banks, and the community bank says, I'll tell you what we're going to do. We'll in fact make 6 payments a year, not 12 payments a year, which is what the institutional banks only offered, was 12 monthly types of things. This community bank says what we'll do is we'll do them in 6 payments, all of them going to be double payments, all during the summer months when you have the cash flow to do that. So we've moved from institutional banks to community banks. But if we leave the world of the banks, we can go to private lenders. There are organizations out there that get money from a bunch of high net worth investors. They hire a loan officer and they say, go forth and make us some riskier loans than the banks might do, but with higher rewards associated with that. In Colorado here, we have a company called Dream Springs that does that. It's a private organization. It's private money. It's not through a bank. Depositors are not insured or anything like that. Now, as you might imagine, if you move from institutional bank, the rates and terms are going to be probably the best. When you go to a community bank, they're going to be probably just slightly more in the favor of the lender. And when you get to, in this case, private lenders, and essentially it's probably going to be even more in favor of the lender. But even once you go beyond those, and that's the typical debt financing, typically we think about them in term loans as opposed to lines of credit or something along that line. So where you're paying a principal and interest payment on a monthly basis or something, we have what we call specialty lenders. And specialty lenders could be factoring companies, which eventually will take an invoice that you already have maybe issued to a client and then fund a certain percentage of that, maybe 90% on the day that they receive the invoice from you. And while it sits in the the other company's accounts payable, while it may mature for 30 or 45 days until it finally gets paid, depending on that length of time, they might give you back a little bit more of that holdback that they have. So maybe they fund it at 90% of the face value, they hold back 10%, and if the client, your client, ultimately pays the factoring company, let's say within 30 days, they might give you 5% back. So the total cost of that loan, essentially for a 30-day loan, was about 5%. If you do the math on that, that's a 60% per annum loan. It gets pretty expensive, but like I mentioned, you move down that continuum, money gets a little bit more expensive. But in many cases, that may be the lifeblood that you need to be able to remain in business. Once you go even beyond that, there's other ones in there like a lot of people don't even think about are leasing companies. So maybe you own a product already. What you end up doing is you give that product, give it to the leasing company. They in turn create a payment program. It's kind of like doing a second mortgage, if you will, on your house and taking some of the equity out. But these are alternate ways when I think about the debt continuum, as you can move down there to think about how you might be able to make principal and interest payments that goes beyond your typical institutional banks. Hope that was helpful, and be sure to check out Steve Biz Blog for lots more information.